All right, you all, we are back. We are back. We are back. Sorry about that technical difficulty. That was more like a technical blunder. I was doing a lot of talking. I was talking for about 10 minutes. Didn't see the comments until later because I'm sharing screen on some articles that we were reading. And yeah, so, but anyways, we're back. I got some practice in. We're back. We're going to run through this thing so smooth. So let's go ahead and get to the intro. Let me catch my breath real quick. I did a lot of talking, a lot of wasted breath, but we are here.
Think. Act. And prosper. You are now tuned into the Money Level Show.
All right, all righty. We are back. We are back. So today we're going to talk about should you buy more gold? It's an interesting article that came out from the Wall Street Journal that I want to dive in. And we're also going to talk about are Fed rate cuts coming? Is the Federal Reserve going to cut rates this year? There was a lot of talk about Fed cutting rates. I thought the Fed was going to cut rates just by the way that inflation was moving. Inflation was moving down. And obviously we're in an election year and all of these different things and I fed into the bias of the Fed cutting rates. However, that is why we've seen a huge rise in the markets. And so we got a few people in here. So if you could drop a comment, make sure that you can hear me, that would be awesome. Just before I get into sharing screen and everything and doing all this talking and and all of that. So let's go ahead and I'm gonna go ahead and jump over here to our first screen of what I was showing in terms of the S&P 500. So this is where we're gonna jump first. S&P 500. All right, so here we are. So this is a chart, the S&P 500. As you can see, S&P 500, for those that don't know, is a pretty much a index ETF. It's a basket of the best the best 500 companies on the market. So it's called the Standard & Poor 500. As you can see, we had a low in March of 2020, and that was $2,191. The S&P since then has risen and has reached all-time highs. The all-time high for the S&P is based off this candle here. The all-time high was $5,261. If we look at the chart for the all-time chart, as you can see, the S&P hit all-time highs, and this was so this was the COVID low, and it's just been spiking up. So it's hit all-time highs multiple times this year, and this is what we're going to look at here, right? So, well, first, just to give context, October of 2020, Fed starts buying government debt. They start bailing out corporations. We get PPP loans, all type of stuff, right? And just fueling the market upwards, right? It just fueled it up significantly. So that's what we're seeing at that part of the chart from early 2020 to late 2021. Late fall 2021, that's when the Fed announced that they were going to start raising interest rates. The S&P 500 just consolidated, and then it started to break down. As you can see, I mean, you had Russia, Ukraine, and everything started to break down, and it went further. And then ever since then, it's been on a tear to hit all-time highs again. So ever since October, it's just been running. You see all these green candles here? This is the S&P 500 just running, hitting all-time highs. It started to break out of that pattern. So what's happening here? Well, here there was a lot of talk about Fed rate cuts, which when the Fed cuts rates, that eases the pressure on many corporations, because corporations have debt that have interest rates on them, right? And so the higher the interest rate, and if the company has to finance that debt at a higher interest rate, that hurts their profits, that hurts their revenue, because it's going towards their debt, right? Same thing for average people. When you have higher interest rates on credit cards and such, you have less money that you can spend. So when the Fed cuts rates, we can say the same thing for mortgages, right? When the Fed cuts rates, the interest rates reduce and people have more money to spend. And so that is why the market was getting bullish, because there was talk of like, okay, the Fed's going to cut rates in 2024. And that's why we saw this huge run up. So now what we're going to look at is over here on this article. This article talks about the Fed. Even if the Fed cuts rates, the days of ultra low rates are over. So what this, the author, the writer of this article is saying is that there's used to be a neutral rate, and pretty much the Federal Reserve and policymakers continue to move the bar lower for what the neutral interest rate should be. So if we look at interest rates in 2018, they were around 2-3%. And then when COVID hit, they went down to 0%. So, so now we're trying to find that where's the neutral rate? Where should interest rates be? So amid the debate over whether and when the Federal Reserve cuts interest rates, another important argument is unfolding. Where do rates settle in the long run? At issue is the neutral rate of interest, the rate that keeps the demand and supply of savings in equilibrium, leading to stable economic growth and inflation. Over the last 40 years, and especially following the 2008 financial crisis, economists and Fed policymakers steadily revised down their estimates of neutral. This view became embedded in bond yields, mortgage rates, equity prices, and countless other assets. All right, so that's a loaded paragraph, right? So what we're going to do is we're going to break that down. So let's go to Fed interest rates chart. We're going to go to the Fed, the Federal Reserve, St. Louis Fed. All right, so this is what we're going to share. I'm giving you all some of the mechanics of how this stuff works. The mechanics of how this stuff works. If that interests you, right? It interests me because it helps me be able to position myself accordingly. So as you can see, over the last 40 years, right? 40 years ago, interest rates were, let's see where they're at. They were at about 11%. The height, if you go from 1980, interest rates hit 19%. So interest rates have been on a decline. They hit 17% in 1980 and then 19% in 81. So interest rates have been on a decline ever since we had high inflation and we had Paul Volcker and the Fed in the 80s come in to break the back of inflation. If you talk to people that had mortgages back then, they say they had 13, 14, 16% on their mortgages. So interest rates have been on the decline since then. I mean, you have these little bounces here and there, but they've been on the decline. So as we can see, during the COVID period, it hit zero. Also, after the 2008 financial crisis, the Fed cut rates drastically and they hit zero again. So we don't know where the neutral rate is, right? So in 2018, 19, we had 2%. We don't even know where the neutral rate is. So where's it supposed to be steady at? Where's the steady interest rate that we need to be at? So that's part of what this article is saying when you read this paragraph. For over the last 40 years, and especially following the 2008 financial crisis, economists and Fed policymakers steadily revised down their estimates of neutral. Now see some reasons for neutral rising with the potential to change a wider range of assets. And the neutral rate is sometimes called the R asterisk or the R star. Can't be directly observed, only inferred. 5 years ago, after the Fed raised its benchmark federal funds rate to 2.4%, officials saw signs of feeble growth and inflation and began lowering rates, implying neutral must have been around that level. So they're saying neutral must have been around 2.4% over the last 5 years ago. So now they're saying now the market is estimate is predicting that the neutral rate would be about 4.1%. So right now the Fed has rates at about 5.3%. They're saying that the neutral rate would be about 4.1%. All right. So that's why the markets were running. That's why they were. Can y'all still hear me? Make sure y'all can still hear me. Please drop a comment if you can still hear me loud and clearly. Had some weird error message come up. If the error message come up, I'm gonna just have to delete this and save this for another day because I need to go eat. All right. Hey JT, can you still hear me while I'm sharing screen? All right, JT will get to me. Okay, so that's what we're seeing here. The neutral rate, the markets are expecting the neutral rate to remain about 4.1%. So even if the Fed were to cut rates, they're still going to be higher. They're most likely not going to go to zero unless we have, if we have a significant crisis or something of that nature, the Fed may cut rates to zero. I could see that. So now we're just going to jump over here to this article. So, okay, cool. Thanks, JT. All right, so this one talks about the last GDP report and why it's a fool's game to bet on the Fed's interest rate moves. Buying stocks after the final rate hike in a cycle demands perfect timing. So for more than a year now, investors have been playing a largely pointless game of predicting when the U.S. Federal Reserve will start cutting interest rates. The reason it's pointless is not that the Fed has yet to start cutting, though it is true that investors' game playing up until now has been in vain. The real reason the game is pointless is that winning does not help you beat the market. Take a look at the chart below, which is based on U.S. rate cycles since 1980. The orange columns represent the U.S. stock market's average return subsequent to the first rate cut in the Fed rate cutting cycle. Notice that it is below the stock market's average return across all periods of comparable length. All right, let's see what this is saying. All right, so we see that. Okay, so the orange. Okay, so this is pretty much after the first rate cut in the cycle. So after the first cut, the 3 months after the first cut, the gains that you see would be typically about okay, so this is the Wilshire's total return average index. Okay. All right, so after the first rate cut, the gains that you'll see is close to 2%. And then 6 months after, you'll see about 6%. And then about 12 months after, you will see about a little over 12%. So it says, consider what this means. If over the past 4+ decades, you had invested a lump sum in the U.S. stock market on each of the exact days the Fed began cutting rates, you'd on average have underperformed the market over the subsequent 3, 6, and 12 months. So this is the market here, the green. So this is the market. So they're saying that you would have underperformed if you start betting on the Fed cutting rates. The chart also shows the U.S. average return subsequent to the last hike in a rate hike cycle. While the average subsequent return is modestly higher than the overall market, you still would have needed perfect foresight to know that each of those final hikes was indeed the last one in the cycle. All right. So they get kind of advanced over here, y'all. I'm trying to make sure I understand it fully and clearly. The past year provides a good illustration of the foresight that would be needed. Many assume that the last day of the recent rate hike cycle was July 26, 2023, which is indeed when the Fed last raised rates. but it isn't a sure thing that it would be an absolute final hike in this cycle. So they're saying that there's no guarantee that this will be the final hike because we have inflation creeping up and everything. So you can't just bet on that. First quarter GDP numbers released this week increased the odds of this possibility, though the headline GDP increase was lower than a Wall Street consensus expectation. Consumer spending, the engine that's kept the economy going, rose at a healthy clip. Given the economy's strength and stubbornly high inflation, some are now seriously considering the possibility that the Fed's next rate change will be an increase, not a cut. So they're saying that even though the gross domestic product, which is the production of our nation, the private sector and whatnot, and they're saying that that number came in lower than the consensus, but consumer spending was the engine that kept it pretty much higher. So consumer spending rose, and that means that money is flowing, that consumers are spending, that the economy looks a little more healthy. But overall, it's saying that and the high inflation is stubbornness. Inflation is being stubborn, and so they're saying like, okay, well, will the Fed cut rates when inflation continues to rise? Inflation continues to tick back up, and so now they have to factor in, okay, well, the Fed may not cut rates now because inflation is going the opposite direction of where they wanted it to go. So that means that it's possible that they could increase the rate again. So that's what this article is talking about, with people betting that the Fed is going to cut rates. So as we can see, I mean, there's just multiple articles on this. We're not going to get into all of them. The dream of the Fed rate cuts is slipping away. This means that the market could take a big downturn. It could take a downturn because people were betting on these rate cuts so that it could be bullish for the markets. So that's where we're at with that. All right, so we're going to jump over to this article about gold. It says gold has gone gangbusters. Retirement savers shouldn't get carried away. Let's see what she's talking about. Gold has shined brightly this year, returning about 13% and outpacing the S&P 500. But does the precious metal deserve a place in your retirement portfolio? It does in mine. All right. While gold has pulled back a little lately, the case for owning it looks strong now. Inflation remains hotter than policymakers would like, and gold is viewed as an inflation hedge. Geopolitical tensions are running high with wars in the Middle East and Ukraine, and gold's run up to about $23.32 per ounce has defied its normal pattern of falling as interest rates rise. I'm trying to see when this article came out because, it came out 4 days ago. Costco, for one, can't keep its gold bars in stock, but much of that recent demand driving gold's price to record highs comes from central banks. Experts have noticed some pros see the price moving even higher if everyday investors follow suit. What's more, when the Federal Reserve eventually starts cutting rates, that may be an additional tailwind for the metal. So that means that the gold will go higher when the Fed eventually starts cutting rates. And then it says some of gold's strongest performances have come during Fed cutting cycles, according to a recent commentary by Wells Fargo. All right, beyond the investment case, bullion is often pitched as the ultimate store of protection against calamity. Commercials for gold IRA accounts and that can accommodate physical gold tout them as a way for retirees to safeguard their life savings, yet these accounts can be costly and illiquid and are inappropriate receptacle for a 401k rollover. All right, so there's a problem with the gold IRAs. Gold's role in the doomsday scenario is dubious. Proponents argue that a physical gold would be valuable in a barter economy that could emerge following a social and economic catastrophe like a major war. Others say gold wouldn't be nearly as useful as goods to sustain life. Bottom line, retirement savers shouldn't get carried away. All right, shouldn't get carried away. Now, I've talked about this multiple times. I believe that gold has always been a store of value. It has always been done well in war, but it doesn't necessarily happen in a straight line. So I was reading a book called The Death of Money, where gold in Weimar Germany, pretty much like um, there was times where gold would go lower, gold would go higher. So and the currency would go lower and higher, then eventually gold went higher. So you can't say that gold is just going to go up in a straight line. It's not going to do that, but it will hold value, right? But when you think about the balance between having food and fuel, those are very critical. I mean, water is going to be it's a basic need, critical need for the human body. So when you have water, that's going to be something that's going to be very valuable as well. But it's going to be more valuable than gold. You know what I mean? So you got to think about things like that as well. So that's why they're saying that retirement savers shouldn't get carried away, because you're going to have other stuff if you're betting on catastrophe. For starters, there's an opportunity cost. While gold has outperformed large cap U.S. stocks this year, it has underperformed equities over every 10-year period for the past 100 years. All right, so I'm not even going to listen to that, because it's true, but it's just the same narrative that they both serve different purposes, and they're looking at gold as an investment. So obviously putting it in a retirement account is looking at gold as an investment versus like insurance for your money. I view gold as holding a different purpose. I don't view gold as like, okay, I'm going to invest in gold to beat the stock market. Like, no, that's not why I hold it. I hold it because it helps me sleep at night. Unlike bonds and dividend stocks, moreover, gold doesn't throw off income, and it comes at carrying costs such as fees, exchange traded funds like the SPDR Gold Shares, which charges 0.40% annually. So, I mean, they got some good points about, if you're comparing gold as an investment, like I can relate to what this person is saying. However, they're not really talking about the gold being the insurance against the dollar, the ballooning deficits. I mean, the debt, right? All of those things. So yeah, I think that's missing from this article. If you do want gold, keep it to no more than 5% of your portfolio. Advisors say it's easy to get exposure through the ETF. Just be aware of tax implications. The ETF, for instance, is structured as a trust. Gains a year are taxed as collectibles. Gains held for more than a year are taxed as collectibles at the collectibles rate of 28%, which is higher than long-term capital gains rates. So that's a reason why not to own the ETF. So the SPDR ETF is structured as a trust. And if you were to sell your gold and you held it over a year, it's taxed as collectibles, and you're being taxed at 28%. So that's why some people don't fool around with the gold paper market at all, especially for some BS like that, right? That makes it best to hold the gold ETF in a tax advantage account, such as an individual retirement account, which is also a good place for other commodity ETFs that can cause income tax headaches. While investing case for owning gold is shaky, there may be psychological benefits. The yellow metal worked well as a portfolio since during the financial crisis of 2008 to 2009, outperforming stock. When stocks tanked, holding some gold during the stretch may have helped investors sleep at night. So yeah, that's why I want to hold gold, is because it helps me sleep at night, and it helps me hedge and insure my money against any type of economic catastrophe, economic disaster, government, debt defaults, and all type of stuff. Right? It's one of the assets that is not someone else's liability. So that's why I own gold. So why do you own gold? Leave that down in the comment section below. We jumped into a lot today. It's very, I thought this was going to be just a quick live. I had some pretty much technical issues early on, but yeah, I wasn't expecting to just consume so much information in this live. But I hope that this was helpful for you all. Don't bet on the Fed to cut rates. Inflation staying sticky, and they may hold rates for longer, which could ultimately impact the markets. And then the other recap is that you may want to just focus on holding physical gold rather than messing with the ETFs. So with that being said, y'all have a blessed night. I'm uploading an interview tomorrow, so be sure to be on the lookout for that. That's with Dave Collum. We talk about some of the things that we read about tonight. So, all right, y'all have a blessed night. Peace.